How can I use Six Sigma to build algorithmic trading strategies? Applying Six Sigma methodology to develop algorithmic trading strategies involves a structured approach to designing, testing, and refining trading models, ensuring they are statistically sound, robust, and aligned with specific goals. The DMAIC process, define, measure, analyze, improve, and control, guides each stage of strategy development with a focus on minimizing error and maximizing efficiency. In the beginning, you start by defining the purpose of the trading strategy and setting financial goals. For instance, suppose you want to create an intraday trend-following strategy for the S&P 500 futures market. Here, your objectives might include achieving a 10% annualized return with a maximum drawdown of 5%. It's essential to clarify the scope, such as time frames, market conditions, and risk limits, so that later you have concrete criteria for evaluating the strategy's success. The next stage involves measuring key performance indicators, KPIs, relevant to the strategy's performance. These might include average return per trade, which measures profitability per trade, win-loss ratio, indicating how often the strategy wins relative to losses, drawdown to assess risk, and the Sharpe ratio, reflecting risk-adjusted returns. Let's say your strategy currently generates an average return of 0.2% per trade, with a win rate of 55%, but you notice that drawdown levels are higher than expected. Backtesting with strategy Quant X over multiple datasets, such as different time periods, can reveal consistent performance patterns and pinpoint weak spots. Perhaps drawdown spikes occur during volatile market periods. Analyzing the strategy to uncover improvement opportunities is the next step. This stage involves digging into the strategy's components to understand what drives its performance. For example, failure mode and effects analysis, FMEA, can help identify which parts are most susceptible to failure. Suppose you find that entry signals based on a moving average crossover are effective in trending markets but lead to losses in choppy or range-bound markets. Using regression analysis to detect correlations between market conditions and strategy performance can be helpful. For instance, you may observe that the strategy underperforms when the 14-day Relative Strength Index, RSI, on the S&P 500 is below 40, indicating oversold conditions. Adding an RSI filter to avoid trades in oversold markets could then reduce losses in unfavorable conditions. From here, you focus on improving the strategy's design based on the insights gained. This might involve adjustments like optimizing moving average lengths or adjusting stop-loss levels to improve risk, reward, adding filters to enhance trade selection, such as only allowing trades when RSI is above 40, based on the previous example, or modifying entry-exit rules. For instance, instead of entering a trade on every moving average crossover, you could require both the crossover and the RSI condition to be met. Backtesting these adjustments will reveal their impact on performance metrics. If, after these changes, the win rate increases to 60% and the drawdown decreases by 2%, this suggests the strategy is now more reliable and aligns better with its initial objectives. The final step involves controlling and monitoring the strategy's performance to ensure it operates within acceptable limits. Setting control limits for each KPI, such as acceptable ranges for daily profit, loss, drawdown, and trade duration, helps monitor adherence to benchmarks. If, for example, the strategy experiences a drawdown exceeding 5% in a single day, this deviation could indicate a performance issue. Here, Six Sigma's control principles suggest temporarily disabling the strategy for review. Automated alerts can signal if performance metrics stray outside control limits, prompting you to analyze the parameters or market environment. Six Sigma's control framework supports routine audits, perhaps quarterly, to evaluate strategy performance against current market conditions, volatility patterns, or other factors, ensuring its continued effectiveness. This DMAIC-driven approach in Six Sigma ensures that each phase of strategy development is meticulously tested, analyzed, and refined. The emphasis on data-based decision-making and ongoing improvement creates a more resilient and adaptable foundation for automated trading strategies, enhancing their likelihood of success across diverse market conditions.